Welcome to the Deep Dive, your express route to becoming truly well-informed. Today, we're digging into the Indian jewelry market, and we're doing that by looking closely at Sky Gold and Diamonds Limited's latest Q1 FY26 earnings.
Yeah, it's a fascinating company in a really dynamic sector right now.
Absolutely. Our source material for this deep dive is straight from the horse's mouth, the company's recent earnings conference call. It's packed with insights from their MD and CFO. So, our mission today, to really unpack the critical bits from that call, we want to help you understand Sky Gold's business, where the industry might be heading, and, the risks involved. We're going to explore how this company isn't just sort of reacting, but actually trying to shape its path forward.
It's a proactive strategy.
So to really get a handle on where Sky Gold is going, we first need to understand their foundation. They're a B2B gold jewelry maker, right? And they have this strong focus on lightweight designs. Now that seems specific. Why is that specialization such a key differentiator for them, especially right now?
Well, it's really smart positioning, actually. What's fascinating is how they've adapted. The whole fine jewelry market in India is changing fast. You've got a few big things happening. First, gold rates have surged, and that's definitely impacting what people buy. Second, you see women increasingly making the buying decisions. It's more about personal style, less just about traditional investment value.
Right. More design-led choices.
Exactly. And that leads to the third point. People want sleeker, more modern pieces they can wear every day, not just heavy stuff for weddings. So Sky Gold saw this. They shifted from just churning out generic designs based on volume.
The old way of doing things?
Yeah, the old way. To a model that's really led by design, focusing on craftsmanship, complexity, making pieces that are light but still look and feel substantial, elegant. And you see it in the numbers. Their 18-karat jewelry volume, for instance, it's jumped from about 4% of their mix to 7%. That's nearly double. Plus, they've launched these innovative featherlight 22-karat designs, too.
Featherlight, interesting.
It is. So, the bottom line, this shift lets them command better margins, because they're adding value through design, not just selling gold weight. It gives them a bit of a buffer against those volatile gold prices.
That makes a lot of sense, focusing on value add through design. Okay, but they also mentioned these specific business models, the advanced gold model and job work. These sound pretty central to their profitability strategy. Can you break those down for us? What exactly are they, and how do they impact the financials?
Absolutely, and they are crucial. The advanced gold model is, well, quite clever. Basically, the customer, usually a large retailer, provides the raw gold. Sky Gold then just charges making charges. That's typically around 5.25% to 5.75% of the final product's value, not the total gold value.
Okay, so they don't have to buy the gold themselves.
Exactly. And that's huge. It dramatically boosts their profit before tax, their PBT, and significantly improves their return on capital employed, the ROCE. Because think about it. They aren't tying up massive amounts of working capital in gold inventory. In a market where gold prices swing wildly, that de-risks things considerably.
Less capital tied up, less risk.
Got it. Right. And then there's the job work. That segment's volume is also climbing fast from 2% to 5%, and they're actually targeting 7.5%. In jewelry, job work means the client gives you the materials and you just provide the skilled labor, the design, the manufacturing expertise.
Yeah, so again, they're getting paid for their skills, not the material cost.
Precisely. It's highly margin accretive. Both of these models, advanced gold and job work, directly feed into better gross margins because Sky Gold is monetizing its manufacturing skill and design innovation, not just trading gold. It shifts the financial burden and makes the whole operation much more efficient.
Super efficient, it sounds like. But is there a catch? Like any downsides or risks to relying so heavily on these models? Maybe dependency on the clients having gold?
That's a fair point. The advanced gold model does depend on the clients having their own gold supply or financing, yes. So I suppose a major credit squeeze affecting their clients could theoretically slow down demand for that model. But Sky Gold seems to mitigate this by focusing on large, established retailers. These players usually have pretty solid financing and supply chains already in place.
Okay, that makes sense. Risk mitigation through client selection. Now, these models are clever, but it's not just how they make jewelry, it's who they're making it for, right? They seem to be really aggressive on the expansion front, adding some big names. How significant are these new clients like Reliance Retail? Does this fundamentally change their market standing?
Oh, absolutely. Their client acquisition is a huge part of the growth story. Landing major players like Reliance Retail, PMJ Jewelry in Hyderabad, Kalamandir, that's massive. It's not just adding logos. It gives them access to enormous distribution networks across India, tapping into rapidly growing retail chains.
And they're getting more business from existing clients too.
Yes, exactly. They're increasing their wallet share, the proportion of business they do with big names they already work with, like Aditya Birla, Carrot Lane, PNG. And importantly, the earnings call mentioned that specific job work orders from Reliance and Aditya Birla are actually set to kick off in Q2. That's like now. So we should see an impact pretty quickly.
Okay, so domestic expansion is firing on all cylinders. But they're looking beyond India too, aren't they? There was talk about Dubai and an acquisition in Ghana.
Correct. They're definitely thinking globally. They've set up a wholly owned subsidiary in Dubai. The plan is to have a sales office running there by early August. The strategy for Dubai is twofold. First, strengthen exports to the Middle East. They see it as a key growth market.
Makes sense.
But second, and this is really interesting, is what they call the rate difference advantage. They can actually buy gold in Dubai cheaper than in India, maybe $10 to $15 less per ounce due to lower premiums. Then they bring it to India, use their efficient manufacturing to process it, and sell the finished jewelry back at Dubai rates.
Wait, so they're arbitraging the gold price difference legally?
Yeah, essentially. It's a smart way to leverage Dubai's market dynamics. They stressed it's all fully compliant with regulations. It basically creates another profit stream just from sourcing gold cleverly.
Wow, that's smart. And the Ghana acquisition, Ghana and gold.
Right, that one's expected to close very soon, maybe in the next week or two. This adds another 150 kilograms per month of capacity. And crucially, it's going to operate purely on a job work basis.
So more high-margin business without big capital outlay.
Exactly. Boosts gross margin and EBITDA without needing heavy investment. So if you add it all up, 750 kilograms from the main company, 150 kilograms from their existing subsidiary, and 150 kilograms from Ghana and gold. That brings their total potential monthly capacity to 150 kilograms. That's a serious scale up.
150 kilograms a month potential.
Okay.
And this isn't just talk, right? The Q1 numbers seem to back up this growth story. That revenue figure really stood out.
It did. The Q1 FY26 financials look pretty impressive. Consolidated revenue was 11,131 crores. That's up 56% compared to the same quarter last year.
56%. That's strong.
Very strong. And production volume averaged 456 kilograms a month, which is up 30% year on year. Exports chipped in about 131 crores, roughly 12% of the total revenue, showing that international push is gaining traction.
And what about profitability? Did the margins hold up with that kind of growth?
They actually improved. Gross margins went up by 163 basis points. That's 1.63 percentage points, reaching 8%. EBITDA margin improved too by 115 basis points to 6.3%. And PAT, profit after tax margin, was up 92 basis points to 3.9%.
So growth and better margins, what's driving that improvement? Still the advanced gold and 18K focus.
Primarily, yes. It's that mix shift, more advanced gold volume, more sales of 18 karat, and those new lightweight 22 karat designs. They all carry better margins. But a really key point they emphasized on the call is their hedging policy. They stated they are totally hedged on inventory, sales, and purchases.
Totally hedged. What does that mean in practice?
It means fluctuations in the raw gold price don't directly hit their profit margins. They've locked in prices or used financial instruments to protect themselves from those swings, whether the price goes up or down. It removes a major source of volatility from their earnings.
Okay, that provides significant stability then. It's especially important with gold prices being what they are. Now, you mentioned working capital earlier. That's always critical in this business. They talked about gold metal loans or GMLs. Can you explain those? How do they help?
Right. Working capital management is clearly a big focus. They've secured GML limits totaling 190 crores from Federal Bank, Axis, and Yes Bank. GMLs are basically loans where the bank gives them the physical gold directly instead of cash. This is usually cheaper financing than typical working capital loans. It lets them get the raw material up front without draining their cash reserves, which helps smooth out production cycles. And apparently, GML interest rates have come down lately to around 4%.
So cheaper funding and better cash flow.
Exactly. Their goal is to have 75% of their volume funded through GMLs by the March quarter. That should further reduce their financing costs. And they're also tackling it from the other end, getting paid faster. They've cut their debtor days, the time it takes customers to pay, from 38 down to 32 days.
It's a good improvement.
It is. And they're aiming for 25-26 days. So you combine faster payments, the capital-light advanced gold model, and cheaper GML financing. It all works together to really improve their financial health and efficiency.
It paints a picture of a company tightening up its operations significantly. Okay, let's shift focus to the future. What's the general outlook for the Indian jewelry market? Is the growth sustainable, especially with potential economic headwinds or price swings?
Well, despite that gold price volatility we saw in Q1, things got a bit quiet from May to mid-June when prices spiked. The underlying trend in the Indian market is still quite positive. Demand is still driven by festivals, cultural traditions. Gold is deeply ingrained. But the big story is the expansion of the organized players. You're seeing a clear shift away from the unorganized sector towards established brands and retailers. And consumers are definitely leaning towards that lightweight, lower carat studded jewelry we talked about.
Which plays right into Sky Gold's strategy.
Precisely. So the outlook, especially for the organized part of the market where Sky Gold operates, is for strong, sustainable growth. It feels like a market that's consolidating and formalizing.
Okay, so a favorable market backdrop.
Yeah.
Given that and their recent performance, what are Sky Gold's own targets looking like? They sound like they have some ambitious numbers in mind.
They really do. They're targeting revenue of 5,400 crores for this fiscal year, FY26, and then 7,600 crores for FY27.
Wow, okay. Big jumps.
Huge jumps. And on the volume side, they want to be exiting FY26 producing 650 to 700 kilograms per month. They expect a steady ramp up, maybe 580 kilogram month average in Q2, hitting 630 in Q3, and then reaching that 650 target in Q4.
What gives them the confidence to aim that high? Is it just the new clients?
It's a combination of factors. A big driver is their existing large corporate clients expanding their own store networks, apparently. These clients plan to open around 2,500 new stores combined over the next couple of years, plus gaining more wallet share from those clients and adding new ones through that attractive advanced gold model. It all stacks up.
And exports, are they expecting growth there too?
Yes, significant growth. The target is for exports to be 17–20% of revenue in FY26, climbing to 25% in FY27. They also guided for PATI margins to gradually improve to the 4.25–4.5% range by FY27, mostly thanks to those GML savings kicking in and more high-margin advanced gold business. Longer term, they're currently tiny in the grand scheme, maybe 0.5% market share, but they aspire to capture 4–5% of India's total 650-ton annual jewelry market within 5 years. An initial milestone is hitting 1 ton, 1,000 kilograms per month by 2027, and they expect to be fully cash flow positive by March 2027. So it's ambitious, yes, but seems grounded in the market shifts and their specific client growth.
A very clear roadmap, but of course no plan is without risks. The earnings call disclaimer always mentions uncertainties. So putting it all together, what are the main potential bumps in the road that you see or that the company acknowledged?
Right. You always have to consider the risks. They were quite upfront. Gold price volatility is the perennial one, isn't it? But as we discussed, that comprehensive hedging policy they have in place should significantly insulate their margins from direct hits. That's a major mitigator.
Okay, so hedging helps there. What else?
There's the risk that very sharp, sudden price increases could dampen consumer demand, even temporarily. They saw a bit of that in Q1, remember? So overall market sentiment is still a factor. And working capital management, while improving, always needs careful attention in this industry. You need to keep collecting payments quickly and manage inventory efficiently.
Especially with that targeted growth.
Exactly. Growth consumes capital. But again, their focus on the advanced gold model and securing those GMLs are direct strategies to manage this risk. I think the key takeaway on risk is that their diversified client base relying on multiple large retailers, and these capital-efficient business models provide a pretty strong buffer against potential shocks. They seem built for resilience.
Built for resilience. That's a good way to put it. So wrapping this up, this deep dive really shows Sky Gold and Diamonds is a company making some very deliberate strategic moves. That shift to design-focused, lightweight jewelry, the clever business models like advanced gold, the aggressive expansion both in India and now overseas, it points to a clear vision in a market that's definitely changing.
Absolutely. They seem to be reading the trends well and positioning themselves effectively. And maybe that leaves us with a thought for you, the listener, to consider. As these trends continue, evolving tastes, maybe ongoing price volatility, how else could companies like Sky Gold innovate? What other strategies might they use to grab even more market share, not just in India, but on that global jewelry stage?
A great question to ponder. Where does the innovation go next? Well, thank you for joining us on this deep dive into Sky Gold and Diamonds. We hope this gave you a much clearer picture of the company and the forces shaping the Indian jewelry market today. Keep exploring.